This week for Tesla, a major production pivot takes center stage as the company shifts resources from cars to humanoid robots. While some on Wall Street are betting big on this AI-driven future, the stock faced continued pressure from a cooling auto market and ongoing regulatory battles. Is Tesla's bet on robotics a path to new highs or a risky distraction from its core business? Welcome to TickerWatch News for Tesla, Week 10, 2026. This is your weekly summary of the key developments and market performance for Tesla. It was a challenging week for Tesla shareholders. The stock closed the last trading session at $396.73, marking a decline of over 2% for the day. This continues a period of recent weakness, with the stock down about 3.5% over the past 30 days and roughly 11% year-to-date. This performance trailed the broader S&P 500, which saw a smaller decline. The drop came amid wider market jitters as surging oil prices stoked recession fears, pressuring high-valuation stocks like Tesla. The takeaway is that Tesla underperformed the market as investors weighed macroeconomic headwinds against the company's internal strategic shifts. The biggest story this week is Tesla's deepening pivot from a pure electric vehicle maker to a robotics and artificial intelligence company. Tesla is preparing to convert parts of its Fremont factory in California, which previously produced the Model S and Model X vehicles, into a production line for its Optimus humanoid robot. This move signals a significant reallocation of resources toward what the company sees as a core part of its long-term vision. The stated goal is to eventually produce up to 1 million Optimus units per year, with a Gen 3 version of the robot expected to be revealed soon. In Europe, the sales picture remains mixed. New data showed that Tesla's vehicle registrations across the region increased by 10% in February compared to the same month last year, with notable strength in markets like France, Spain, and Portugal. However, sales declined in other key areas, including the United Kingdom, the Netherlands, and Sweden. On a year-to-date basis, total registrations for January and February are nearly identical to last year's figures, suggesting that while the company is seeing pockets of recovery, a broader European turnaround is not yet secured. On autonomy front, Tesla is facing increased regulatory and legal pressure. The company is now suing California's Department of Motor Vehicles over accusations of false advertising related to its autopilot and full self-driving marketing. This comes as reports indicate that Tesla has still not logged any autonomous test miles in California for the 6th consecutive year, a key step required to obtain permits for a commercial robo-taxi service in the state. Adding to the challenges, Tesla's existing robotaxi service in Austin reported 5 additional crashes in January, bringing the total to 14 since its launch in mid-2025. Wall Street remains sharply divided on Tesla's future. This week, Bank of America reinstated coverage with a buy rating and an ambitious $460 price target. The firm's analysts cited Tesla's potential to dominate the emerging robotaxi market, arguing its camera-based approach allows it to scale more profitably than competitors. However, this bullish take is not the consensus. The stock currently holds a hold rating among analysts, with an extremely wide range of price targets, stretching from as low as $25 and as high as $600. Multiple reports this week highlighted concerns about the company's rich valuation, with its price-to-earnings ratio standing at nearly 400, far above the auto sector average. The overall news narrative is a tug-of-war between the long-term potential of AI and robotics versus the immediate realities of slowing EV sales and regulatory hurdles. From a technical perspective, Tesla's stock is at a critical point. It is once again testing a key support level near $390, a level it has defended twice in recent months. However, the stock has been setting a pattern of lower highs, which suggests that bullish momentum may be weakening. On the fundamental side, valuation is the dominant theme. Reports describe the shares as trading significantly above estimated fair value. This high valuation is being tested by a slowdown in the core automotive business. Full-year 2025 sales marked the first annual revenue decline in Tesla's history. Profit margins have softened to around 4%, and the strategic shift toward robotics and AI will require significant capital expenditure in 2026, creating execution risk during a transitional period for the company. What to watch next week? A key date to watch is March 9th. This is the deadline for Tesla to provide detailed data on its full self-driving system to the National Highway Traffic Safety Administration. The contents of that submission could have a significant impact on regulatory sentiment and the stock. The official reveal of the Optimus Gen 3 robot is also expected in the near future. The $390 price level remains the key support to monitor. A decisive break below this level could signal a steeper correction. The bull case hinges on a positive outcome with regulators and tangible progress on the Optimus and robotaxi fronts, which could reignite investor confidence. The bear case would see further regulatory setbacks or signs of a costly and slow-moving pivot to robotics, which could push the stock into a new downtrend. For now, the base case points to continued volatility as the market decides whether to price Tesla as a car company or an AI powerhouse. Thank you for tuning in to TickerWatch. This podcast is for educational purposes only and is not financial advice. Please subscribe, leave a review, and share this episode to stay informed on the companies driving the market.